Good evening, everyone, and welcome to the Q News Economic Bulletin. I'm Henny Saif, and we will be bringing you the latest top economic stories along with the expert analysis on the events and trends shaping the regional and global economy. Throughout our coverage tonight, we spotlight key sectors and highlight the defining economic developments of the moment. To start with the latest headlines, I'll hand you over to my colleague Rehem Mursi for the top economic stories. Rehem, what do you have for us today?
Thank you so much, Henny. We have plenty of news and developments from around the world. We start with the intercontinental trade deals, as the European Parliament has approved an agreement with the United States, voting 440 to 151 with 50 abstentions after securing safeguards over concerns about the balance of the deal. The deal, first agreed in Turnberry between EU Commission President Ursula von der Leyen and then US President Donald Trump, removes EU tariffs on US industrial goods and limits US tariffs on European exports to 15%. Lawmakers insisted on added protections, including an expiry date in 2029 and the right for the EU to suspend the deal if the US raises tariffs or fails to meet its commitments. Still in Europe, where Britain has imposed new sanctions targeting Russia's energy revenues and military supply networks linked to the conflict in Ukraine, the measures hit the banking arm of Russian tech firm Yandex, two other lenders, and dozens of vessels accused of helping export Russian oil and gas, including parts of the so-called shadow fleet used to bypass sanctions. Prime Minister Keir Starmer said the package targets the vessel, money, and networks supporting Russia's war economy and threatening the European security. The sanctions also include a covert procurement network linked to Russia's military intelligence agency, the GRU, as well as new support of Ukraine's energy sector worth £210 million. In Oceania, the Reserve Bank of Australia has kept interest rates unchanged at 4.35% in a unanimous decision as it weighs signs of slowing economic growth against persistent inflation pressures. The central bank noted that Australia's economy has lost momentum and unemployment has risen, but said underlying inflation remains too high to justify a rate cut at this stage. The RBA said financial conditions have tightened following earlier rate increases and that the economy is slowing as expected. However, it warned that inflation risks remain, pointing to uncertainty in the global economy and potential impacts from ongoing geopolitical tensions and oil supply disruptions. Moving on to Africa, the International Monetary Fund, or IMF, said Nigerians are increasingly using US dollar-pegged stablecoins to move money across borders as households and businesses seek faster and cheaper alternatives to traditional payment systems. The fund estimates Nigeria received about $59 billion in crypto inflows between July 2023 and June 2024, accounting for around 60% of stablecoin inflows in sub-Saharan Africa. It says adoption is being driven by the Naira's volatility and lower transaction costs compared with traditional remittances services. However, the IMF warned that wider use of stablecoins could weaken monetary policy and make financial oversight more difficult. In the energy sector, the head of the International Energy Agency, IEA, has said that full and unconditional reopening of the Strait of Hormuz is essential to stabilizing global energy markets after months of disruption and soaring prices. The IEA chief, Fateh Birol, said the key priority is restoring unrestricted tanker traffic through the vital shipping route, which carries a large share of global oil and gas supplies. He welcomed the recent Iran-US agreement aimed at ending the conflict in the Middle East, saying it would help ease pressure on energy markets and restore confidence. The IEA has also coordinated the release of emergency oil stocks with member countries, drawing down millions of barrels in an effort to stabilize supply. Fitch Ratings has warned that reopening the Strait of Hormuz faces significant political and security risks that could delay or derail any agreement. The agency said tensions in the Middle East include the risk of renewed conflict, would undermine efforts to stabilize the region. However, it said that if the deal succeeds and shipping resumes normally, Brent crude could fall to around $70 a barrel by the end of the year. Fitch added that oil prices remain highly sensitive to geopolitical developments. Oil prices fell about 5% to a 3-month low on Tuesday as traders hoped the U.S. and Iran would agree to end the war and allow oil to flow through the Strait of Hormuz. Prices, which were already down about 4% Tuesday morning, extended those losses following a Wall Street Journal report that the U.S. would allow Iran to immediately begin selling oil and fuel under the Memorandum of Understanding. Brent crude futures fell 5.1% to $78.92 a barrel. U.S. West Texas Intermediate crude fell 5.9% to $75.95. The drop put Brent on track for its lowest close since March 2nd and kept it in technically oversold territory for a third day in a row for the first time since October 2025. WTI was on track for its lowest close since March 4th. The World Gold Council's 2026 survey has revealed that central banks are expected to keep increasing their gold reserves. The report finds 89% expect global gold holdings to rise over the next year, with a record 45% planning to increase their own reserves. It says the trend is driven by geopolitical uncertainty, inflation risks, and efforts to diversify away from traditional currencies. Central banks have also sharply increased buying in recent years, averaging around 1,000 tons annually over the past 4 years. The survey suggests gold demand is likely to remain strong amid continued global instability. Gold prices rose more than 1% on Tuesday as expectations of an interest rate hike from the U.S. Federal Reserve this year eased following an interim U.S.-Iran peace deal that lowered oil prices and reduced inflation fears. Spot gold was up 0.9% at $4,346.09 an ounce. Prices touched their highest level since June 5th in the previous session. U.S. gold futures added 0.4% to $4,366.50. Spot silver rose 0.4% at $70.29 an ounce. Platinum had gained 2.5% at $1,811.15, while palladium firmed at 0.7% at $1,357.91. In markets, SpaceX shares rose above $200 on Tuesday, extending gains in their first week of trading after the company's blockbuster IPO. The stock was up around 11% on the day, following a 20% jump in the previous session, briefly pushing valuation levels towards $3 trillion in intraday highs. At current prices, SpaceX is already among the 5 most valuable U.S. companies, trading roughly 60% above its IPO price. The gains come as the company confirms plans to proceed with its acquisition of AI coding firm Cursor, expected to close later this year. Those were the economic top stories for this hour, and now we head back to Henny Safe in the studio. Henny?
Thank you, Rahim. Now for more in-depth analysis. The world's major economies are once again looking to reshape the global development finance. At this year's G7 discussions, leaders issued a leaders' declaration on mutually beneficial international partnerships, calling for a shift away from traditional aid towards an investment-driven model focused on private capital, financial reform, and more targeted support for vulnerable economies. The G7 says the current system is too fragmented and inefficient and needs reform to improve impact and reduce duplication. But the proposals also raise a broader question. In a more multipolar world, Does the G7 still have the influence to shape the global economic agenda? Let's take a closer look. G7 leaders have issued a leaders' declaration on mutually beneficial international partnerships, calling for a major reform of the global development finance system. Joined by partner countries Kenya and South Korea, the group reaffirmed support for international development cooperation, but said the current system is too complex and needs to be updated to improve efficiency, impact and coordination. The declaration signals a shift towards a more investment-driven model combining public funding, private capital, and institutional reform to support long-term global growth and resilience. Moreover, the G7 has said that its new development strategy will focus more on mobilizing private capital and reforming global debt systems as part of a wider overhaul of international development finance. In the Leaders' Declaration, G7 members and partners Kenya and South Korea called for a shift towards investment-led development, combining public funds with private capital. The plan highlights greater use of blended finance, guarantees, and risk-sharing tools to attract private investment into infrastructure and growth projects. It also urges stronger domestic revenue mobilization in developing countries and improved tax systems to reduce reliance on external aid. On debt, the G7 called for faster restructuring, greater transparency, and closer coordination to address rising vulnerabilities. The G7 said concessional financing should be more strategically targeted towards the most vulnerable countries, including conflict-affected states and economies with limited access to private capital markets. G7 members and partners Kenya and South Korea also called for a more efficient global development system with better coordination between institutions. The group said multilateral development banks and other funding bodies should work more closely together, reduce duplication and avoid creating overlapping financing mechanisms. The declaration also stresses the development actors to strengthen impact and ensure resources are used more effectively. Overall, the G7 says the goal is a more streamlined system that directs aid where it is most needed while improving efficiency and long-term effectiveness. For decades, the G7 has been at the center of global economic coordination. But with a changing balance of power, the rise of emerging economies, and new global challenges, can it still lead the world economy? for a better understanding on this topic, we're joined from London by the economist, Ms. Vicky Price. Welcome, Ms. Price, to Qnews. Now, the G7 has issued a declaration on mutually beneficial international partnerships. How significant is this shift towards an investment-driven development model compared to the traditional aid-based approaches?
Well, it's an interesting move because, of course, what you do want is to encourage growth in all those countries which are struggling at present. Of course, we can't forget that they already have very large debts and that to a considerable extent, COVID hasn't helped. There had been a lot of intervention, of course, from the World Bank and the IMF. A lot of grants were given rather than loans during COVID. But nevertheless, what loads of countries saw was no real diminution in their debt position. So they are struggling still. So encouraging more growth, of course, makes a huge amount of sense. There's always also been another change, which is that for many countries, they're seeing the development finance that used to be there, such as from the US and from various world organizations, seems to have been reduced, partly because the US has withdrawn from some of those international organizations, but also because for many countries, defense spending has taken more of a priority. So we saw that happening, I'm afraid, also in the UK, where what used to be parts of help for nations through the Foreign Office's arm that did that sort of support, now that's been transferred to defense, with a view to expanding it again. But so it is a difficult situation. So you could easily say, well, let's now focus through all the banks, the international banks that we all support as G7, to see that these countries can have investment in various projects that lead to greater growth, and we integrate them in the supply chain. That all sounds good. But what we need to watch is that it's not just an easy way of saying we're going to be doing things differently, but the money that we were going to be allocating to you is going to be reduced.
But do you think that the private capital can realistically close development financing gaps in poorer economies, joining in with the public sector? Or are there the clear limits to what markets can deliver and the traditional challenges and obstacles related to the public sector?
Now, you've got a real point. I mean, there are always concerns that the public sector in a number of countries that need that finance doesn't actually necessarily operate particularly efficiently, or whether you can trust it. So what it requires, if the private sector is to be involved, and I have been involved myself in a number of projects like that in various previous incarnations, what it requires is a support, possibly from those banks that have been set up to help development in the various parts of the world to countries that absolutely need it, providing also guarantees of sorts, or going together with the private sector, so that there is joint finance and joint responsibility, if you like, in terms of the risks that might be involved. So risk sharing is an absolute must. And the understanding then of the country where that investment is going and the public sector in terms of how to work on this and to have proper scrutiny on the finance that's going in and how it's used, and identify the actual results that come out of it, the way that we do in the West, whenever any money is spent. I'm not suggesting that the West spends money particularly efficiently either, but it certainly knows a thing or two, if you like, in terms of how to make sure that value for money is guaranteed and that the returns are then spread the right way across the economy.
But how flexible as well do you think they will be able to adapt to each and every one of the developing economies and how they go on making deals and spend the money?
Well, it can be difficult depending on who you're dealing with. But if you integrate, as we have done increasingly, those various countries in the supply chain, I mean, a number of countries we're talking about, which have been receiving quite a lot of aid, also have strong mineral production, and you can actually develop to a considerable extent their own industries, which can be part of the international sort of business environment, and therefore they can be part of a wider supply chain that they can be part of, then that, of course, can be something which is very beneficial for them if it is done in such a way that then they can also see the benefits going to the country in terms of high employment and so on. But of course, we are talking about a number of countries that still have civil wars in them, which have suffered really badly from pandemics of sorts, which have affected them. So there is also an element, it isn't just growth in the economy, but we can't forget that they need a lot of support on the health front in order to do better. And in fact, in the declaration that I saw, it is pretty wide-ranging in terms of the support that needs to be given, and understanding that there are different ways in which you can support a country. But there is no doubt in my mind that helping growth and helping them have the types of projects and finance going into those countries that will allow that growth, and ensuring corruption perhaps is eliminated, and therefore that those projects will really deliver, is the way to go about it.
Well, what about the global debt, restructuring the global debt, the frameworks? I mean, in the declaration, the terms being used are faster restructuring, greater transparency, closer coordination. I mean, these phrases have been quite frequently used talking about restructuring global debt. How much reform work needs to be done then?
It's interesting when you look at what's been going on just in the last few years. There has been a bit of restructuring, which has been encouraged by the World Bank and others, where the reliance on foreign debt is being reduced, so you can actually get the population to support the endeavors of the government. So you reduce the foreign input into this. Now, of course, it takes, and every time, unfortunately, there is any change in the exchange rate, and suddenly, say, if you borrowed in US dollars, the US dollar rate goes up, then, of course, your debt is in a worse position. But there has been quite a lot of effort in restructuring. And so we had this sort of Paris Agreement and a lot during COVID, as I said earlier, where there has been an attempt to reduce the burdens of debt, and convert some of them into grants rather than loans. And I think that is what needs to continue. In some ways, or in some countries, certainly, complete restructuring of the debt may need to take place. So you convert it into longer-term debt rather than shorter-term debt, because again, if you look at how much debt would need to be repaid, when you look at those composite data that exist, we've seen the World Bank and others warning that global debt is going to be going up very, very significantly. Of course, a lot of that in the Western world, but we need to absolutely make sure that as that happens, developing countries are more shielded from this. And I think there is a lot of work and thinking going on from the multilateral institutions to see how that can happen.
There are loads of question marks regarding the influence of G7 nowadays. How would you assess the G7's relevance in today's shifting global economy?
Well, the one thing to say is that G7 all have quite high debt as well. So we need to bear that in mind. So we're not starting from a position where there is lots of funding available. And this is one of the reasons why they're talking about the private sector being more involved in those countries. But G7 still represents about half the world's GDP. So it is still very, very significant. And of course, it had been G8 for a bit. And then, of course, Russia was no longer in there after the war in Crimea. But of course, you've got China sort of growing, you've got India growing. But G7 still remains as a unit, even though it's an association without any real legal status, is still a very important forum, if you like, for the developed world to be able to perhaps, make the right decisions. I mean, right now, of course, we have Iran, we have Russia and Ukraine. We have worries about climate change, worries about AI, worries about trade, tariffs. And all those issues, if they're looked at from the position of sort of richer countries that can actually do something about it, then that is quite helpful. But of course, we also have the G20, which again in the declaration that came today is there's reference to it and how to strengthen it and make sure that it's supported. So expanding into different groupings, which should allow a much greater representation from the rest of the world, is perhaps something that needs to absolutely happen.
From London, that was The Economist, Ms. Vicky Price. Ms. Price, thank you very much for your insights. Now we turn to a fan favourite, as all eyes are on the World Cup in 2026. The excitement is building. The World Cup returns, bringing with it all the drama, the goals, the global attention the tournament is known for. But alongside the sporting spectacle, another debate is taking centre stage off the pitch. The cost of getting into the stadium. Ticket prices reaching record levels in some cases. Questions are growing over whether football's biggest event is still accessible to ordinary fans or increasingly becoming a luxury experience. Let's find out. US President Donald Trump has praised the 2026 FIFA World Cup, saying ticket sales are moving at record speed and describing the tournament as the most successful in history from a ticketing perspective. Trump said the World Cup was seeing unprecedented demand, with tickets selling faster and in greater numbers than ever before. He made similar remarks in late May, also characterizing it as the fastest-selling World Cup on record. However, critics say these claims do not reflect the full picture, arguing that strong headline sales figures are largely driven by the expanded tournament format and a higher number of matches and tickets available. They also point to concerns that pricing levels are excluding ordinary fans, meaning strong demand does not necessarily translate into broad accessibility. For his part, the FIFA president Gianni Infantino has said demand for the 2026 World Cup has reached unprecedented levels, with more than 6 million tickets already sold. He said interest in the tournament is far higher than previous editions, with demand multiple times greater than past World Cups. However, critics warned that despite strong sales, high prices could leave many supporters priced out of attending matches.
Who to let in the country and who not to let in the country. I don't know.
Meanwhile, Mexico's President Claudia Sheinbaum has joined the debate over soaring World Cup ticket prices, saying the cost of attending matches is beyond the reach of most people. Speaking after Mexico's opening victory, Sheinbaum has said she chose not to attend the match and instead gave up her ticket, arguing that very few fans can afford seats priced in the thousands of dollars.
Los boletos del estadio son muy caros. No sé, llegaron a... no sé cuánto costaban. ¿Ustedes saben? 120,000 pesos. 80,000 pesos, no sé. Entonces es muy poca la gente que puede pagar un boleto de ese con ese monto. Entonces, digo, hay gente que lo puede pagar y qué bueno que fue al estadio. Pero creo que como presidenta, pues mejor le doy el lugar a una persona que no hubiera podido asistir, que ama el fútbol, particularmente a una joven, y lo festejo con la gente.
The 2026 FIFA World Cup is expected to break records on and off the field. But alongside the excitement, ticket prices have sparked a debate about affordability, accessibility and the growing commercialization of global sport. As FIFA defends its pricing strategy and demand remains strong, critics are asking whether the world's most popular sporting event is becoming a luxury experience.
Champions of the world!
The World Cup is finally here. The goals, the drama, the packed stadiums, and the global celebration are back. But for many fans, the biggest talking point is not happening on the pitch. It's the cost of getting through the gate. The 2026 FIFA World Cup, hosted by the United States, Canada, and Mexico, is facing criticism over ticket prices that many supporters say are the highest in the tournament's history. And the numbers are turning heads. A limited number of supporter tickets were made available for as little as $60. Standard group stage tickets started at around $140. Tickets for the round of 32 ranged from approximately $220 to $890. Quarter-final tickets climbed as high as $1,690. Semi-final tickets reached nearly $2,800. And for the World Cup final, official prices ranged from roughly $2,000 to nearly $11,000. But that's not where the story ends. On FIFA's official resale platform, some premium tickets for the final surged to nearly $33,000, fueling accusations that football's biggest event is becoming increasingly inaccessible to ordinary supporters. Despite the backlash, demand remains exceptionally strong. Just before the tournament kicked off, U.S. President Donald Trump praised ticket sales, calling it the most successful World Cup ever from a ticketing perspective.
Everything was going.
FIFA President Gianni Infantino has defended the pricing model, arguing that it reflects market conditions in the United States and helps prevent ticket scalpers from making huge profits. The organizations say that if tickets were sold at significantly lower prices, reseller would simply buy them and sell them at a much higher value. Still, with stadiums filling up and millions of tickets already sold, FIFA insists the strategy is working. For the organization, record demand is proof of success. For many supporters, however, the debate continues over whether the world's most popular sporting event is becoming a luxury experience. As the action unfolds on the field over the next 5 weeks, the conversation over affordability is likely to remain one of the tournament's biggest off-field stories. The World Cup may belong to the world, but many fans are asking whether a seat inside the stadium still does.
For more on this, we're joined from Coventry by the Professor of Afro-Eurasian Sport, Professor Simon Chadwick. Professor Chadwick, welcome to Q News. Now, before we get into the ticket prices, how would you assess the 2026 World Cup from an economic perspective? And who stands to benefit the most financially from the tournament?
So I think the ultimate person who stands to gain the most is Gianni Infantino, because he is going to stand for re-election again after the tournament is over. And so if this tournament ultimately proves to be an economic and financial success, that will provide him with a platform to becoming FIFA president once more. But I think in turn, that's kind of a little naive, a little simplistic to say that. In turn, FIFA will benefit, of course. And FIFA has a remit to essentially be the custodian of the global game and also to promote the development of football across the world. And these are challenging times for football, primarily because there are lots of other sports out there globally that are beginning to threaten football's position. So if we take the NBA, for example, we don't just have the NBA United States, we now have the NBA in Africa, in the Middle East, in India and in China. And so this tournament is also a battle for market share. It's a battle for revenue share. And it's also a battle for FIFA and for football to maintain its competitive position in the marketplace. So this is about benefiting Infantino. It's about benefiting FIFA. To your point in your introduction about fans, well, that's maybe another question you're just about to ask me.
Yes, well, that's true. Well, FIFA says the World Cup tickets prices reflect the market conditions in the United States, the market share, as you mentioned. But is that a fair approach for a tournament that attracts fans from countries with vastly different income levels? I mean, at what point does demand-based pricing risk making the World Cup inaccessible to the ordinary supporter?
I liked your phrase so much, I actually wrote it down on my notepad here, reflecting market conditions in the United States. So the United States is the world's biggest domestic sport economy. It accounts for about 1/3 of global industry size. So this is a huge market in which people are used to spending large amounts of money, not just on tickets, but on car parking, transport, food and beverage services, corporate hospitality, and so forth. So in the context of the United States, you can imagine being sat in Dallas or being sat in New York, or being sat in Los Angeles, and all of this makes sense to you. But of course, it doesn't make sense to you if you're in North Africa or if you're in Europe or in South America or in other parts of the world. Historically, FIFA has priced tickets based upon an assessment of what people, essentially can afford to pay. But what we're seeing at this tournament for the first time is something called dynamic ticket pricing being used. And this is essentially, going back to your phrase, reflecting market conditions. So supply and demand is determining ticket prices rather than FIFA itself. That supply and demand is obviously enabled by digital technology, so your mobile phone or a tablet or a website. And so for matches that are very, very popular, where demand exceeds supply, ticket prices go up. And conversely, when there are less popular matches and there are fewer tickets have been bought, in theory, prices should fall. But of course, this means that there are going to be certain countries, certain games that are incredibly popular and others that are not. But if we can imagine, in your point about the World Cup final, tens of thousands of dollars to watch the World Cup final, essentially the final is being gentrified. So, the kind of heart and soul of football, people from economically disadvantaged communities, as we'd call them, working class communities in Britain, they now have the willingness nor the ability to pay.
But shouldn't FIFA have more of a say in the ticket prices and maybe leave the host country to determine other prices for the accommodation, the food and beverage, the parking, for instance?
The whole reason that the World Cup is in the United States in the first place is for the cash injection that FIFA believed that taking the tournament to North America would bring. Keep in mind, there's a little bit of history here because the United States bid for 2022 and lost out to Qatar. FIFA wanted to take the 2026 tournament to North America because it was supposedly safe and stable and economically advantageous. So, FIFA, in theory, FIFA should step in, but FIFA is in the United States. The World Cup is in the United States to make money. They're not necessarily there to think about economically disadvantaged communities around the world. What I think is really interesting is this just a one-off event? Or is it a pivotal moment whereby the World Cup does become a luxury item? It becomes an entertainment destination. And if you've got a big income and you're willing to pay large amounts of money, but of course that fundamentally changes the nature of the tournament and it fundamentally changes the nature of the crowds that are inside venues.
Yes. From Coventry, that was the professor of the Afro-Eurasian sport, Professor Simon Chadwick. Thank you very much, Mr. Chadwick, for joining us. Ladies and gentlemen, unfortunately, that's all the time we have for this economic segment for today. I'm Henny Saif. Thank you for joining us.